Hello and welcome to today's webcast in our series Sustainability Watch. Today we want to discuss what is called responsible tax. And I'm really looking forward to an insightful debate. But before we get started, let me uh, make you familiar with some of the housekeeping points. First of all, at any point in time, feel free to ask questions. The way you do that is on the bottom left of your screen. You find a chat box, and there you can write your question. We will pick these questions up and either respond to them immediately or at the end of the presentation and discussion. Also, feel free to download the presentation that's being used today. You find the slide deck right next to that chat box at the bottom of your screen. You can use full screen if you want to look at the slides or anything else in more detail. And you can do that by clicking on the four arrows at the top of your screen and also to go back that way. I would also like to encourage you at the end of this webcast to fill in it's done in a couple of minutes, the evaluation of the webcast. It helps us to improve our service to you, so that that would be very much appreciated. Also, we will provide this webcast on demand. It is being recorded, and you can spread the message and get other people to have a look at it if you want to, or if you want to revisit something that has been said, that will be available probably by tomorrow. For those who would like to earn CPE credits, there will be 3 occurrences where you have a pop-up and you just have to respond to that, and you have to do this throughout the webcast. Please understand that if you look at this the recorded version, that possibility isn't there then anymore, of course, for obvious reasons. Okay, so let's get started. And I would like to welcome our presenters. First of all, Ilaria Massarelli. She is the senior economist for Europe at the Conference Board. She monitors the monthly business cycle of European economy and contributes analysis to the Conference Board Global Economic Outlook. She also contributes to in-depth research related to global supply chains and labor markets. Ilaria has worked at the Brussels-based think tank, the Center for European Policy Studies, before since 2007. She is one of the authors of the recently published book, Let's Get to Work, The Future of Labor in Europe. Ilaria holds a master's degree in European Studies from the University of Bologna and undertook further training in economics at the University of Leuven. Welcome, Ilaria.
Thank you, Uwe, for having me here, and hello, everybody.
Then I would like to introduce Dominique Mathon. He's the head of group tax at Relix, a FTSE 20 Information and Analytics Group. He's responsible for the global tax affairs of the group, leading a team of around 50 tax professionals. He has 25 years of experience for companies in the consumer goods business, services, IT and financial services sector, along with working for a professional services firm. Dominic has lived and worked in the UK, Netherlands, and Singapore. He was educated at the University of Oxford and qualified as a chartered accountant in the UK. Today, Dominic is expressing his personal views and not those of his company. Welcome, Dominic.
Uwe, thank you very much. And I should just say at this point in time, I'm a little bit embarrassed that I don't have an exciting background full of books like you do. But I'm perhaps not so embarrassed because my company used to publish a lot of books. We still do publish some books, but we're increasingly now a digital and analytics business. So I guess the blank screen behind you is perhaps more fitting. But anyway, I'm very much looking forward to our conversation.
Thank you so much for highlighting that point. You know, I'm the proud owner of an ebook reader as well, so that's I'm supporting you guys. Okay, good. Before we get further into it, let me also say who am I and who is organizing this. I have the privilege of being the head of the Global Sustainability Center of the Conference Board, and in that capacity, I also lead the European Sustainability Council. The Sustainability Center is trying to bring together research from the US, Europe, and Asia under the guidance of our members. We try to support the companies to create long-term value and positive impact through sustainability integration. We see as the scope the UN Sustainable Development Goals, and we believe that business has to be guided by responsible standards and frameworks. We try to provide fact-based and independent views so that you can trust the content that you receive from the conference board. And in that spirit, we want to get started now on a what is sometimes a highly emotional debate. We're trying to be very rational about it and fact-based. I hope we will succeed in that. For those of you who are tax professionals, this is intended for people who are not so familiar with the details, and therefore have a little bit of patience with us if we sometimes oversimplify. But please feel free to make your comments known in the chat box on the left-hand corner, as I already mentioned. So, after all that introduction, Ilaria, you have looked at some economic data and drawn some conclusions on terms of tax. And for the audience in the US and in Asia, apologies, we focus here on the European data.
Yes, so I think it's always safe to start with the data because you can always trust the numbers. And so yes, I had a look at tax rate developments in Europe, and of course the first step in this is to look at the statutory rates. So the statutory rate is what is the tax rate that is imposed by any state on corporate tax income and profits. And so what you can see here is the statutory tax rate for 1995 in yellow and 2017 in blue. So there are a few things that we can observe in this chart. One is the huge variety among European countries. It goes all the way from 10 to 40%. So this is the first interesting thing. We have a lot of things in common in the European Union. We have a huge single market with 500 million people living in it, but we still have very, very different tax rates on any ground. I mean, not only corporate tax rate, but tax rates for everything is different. So the blue line is a good proof of that, I think. I should say something on France. We chose in this analysis to look at 2017 for availability of data reasons, but actually we know what is the statutory rate also in 2018 and 19. And France, I have to say, 2017 is a very peculiar rate because the tax rate went up a lot, up to 44%, which is what you see here in the chart. But actually, before and after, it was lower. So, for example, in 2018, in the current year, is actually 32%. So a little bit of outlier piece of information for France, but I mean the fact remain. I mean the tax rate, the statutory tax rate in Europe goes all the way from 10% in Bulgaria to above 40 in some countries like the one where I live, Belgium, Malta, and France for this specific year. But as I said, 30% after. So that's the first fact. The other interesting fact is that if you compare 2017 with past years, and I went as far as I could go, so I took 95, you can see that in all countries the rate decreased. And in some countries it decreased actually quite a lot. So if you take the EU weighted average, as of now, the tax rate is 28%, but if you look back at 95, where, okay, the EU was not made by these countries at the time, but it would have been 43%. So we see quite a decrease over time. Now, as I said, this is what state laws say companies should pay, but what actually companies pay is not often the same. And it's not the same for many reasons. One is that there are deductions, there are incentives, there are tax breaks on specific issues, And then if you go to the level of multinational companies, there are other issues which are related to the fact that there are, for example, intermediate inputs traveling across borders. There are issues of double taxation. So basically, it's probably, and Dominique maybe can say something on it, it's actually very easy to calculate the effective tax amount of taxes paid by each company every year and put that in the books. But if you want to do the same at the aggregate level of a country statistics, that becomes very, very difficult. So it's very, very difficult to calculate the effective tax rate. So we have to be creative in trying to get to that number. So what we propose to do, and I lost contact with the slide, so I have to ask Uwe if you can go to the next slide.
It's there.
Okay, thank you. So what I propose to look at is the implicit tax rate. Now, of course, every piece of number that we take in this case it cannot be perfect, but I think this is a solid one, because what we take is the corporate tax receipts as they are recorded by the state in the revenue statistics. So what has been paid by all companies in a specific year, and we divide that by the net operating surplus of all companies in the same year from the national accounts. So we divide these two numbers and then multiply by 100 and get basically to a measure of how much tax is an effective tax rate. Are you with me so far?
I think, Ilaria, it might be good to explain a little bit more what is the net operating surplus.
Yes, so the net operating surplus is a line in the national accounts, and it's a line that basically takes all the outputs of companies, so what is produced by companies, and then by that is deducted things like the cost of intermediate inputs, the compensation of employees, the depreciation of capital, and taxes on production and imports. So it's basically the closest measure, the closest we can get to profits. So for example, what economists use when they want to calculate the profit share of companies, what we do is to take the net operating surplus and divide that by the net value added, and then we get a measure of profits of the private sector. Okay, was that clear?
Yeah, thank you.
Okay, so if you could go to the next slide, you can see that how that formula translates in numbers. And again, so it's the same as the previous chart. So the 95 is the yellow bar is 95, and 2017 is the blue bar. And again, as in the statutory rates, and I think that's quite obvious, there is again huge variety, because that reflects the different rates applied in different countries. But unlike in the previous chart, what you see here is that in some countries for which the data were available in 95, of course, in some countries the effective rate went up, and in some others it went down. So it's not clear what the trend has been over this, let's say, 2 decades. And I think that becomes more clear if you go to the next slide, because here I took the weighted average for the European Union. So it's a bit the same data but presented in another way. I think this one is easier to look. So what you can see is that when it comes to the statutory tax rate, there is a very clear downward convergence. So as I said, we are in the range of 40% in 95, and then we are in 2017 much closer, a little bit below 30. So the statutory rate clearly went down, and there's been convergence, because if you take then the standard deviation between the different tax rates in different countries, you can see that goes down. So that's an indicator of convergence. What is not clear is the trend in the implicit tax rate, because as you can see, well, if you add a trend line to this gray line, it goes up a little bit. But if you just exclude a couple of years, then it goes down. So I think the trend is really not clear. It actually looks to me rather flat, and the only change that I can observe in the implicit tax rate is that there is a cyclical dimension. So when the economy is booming, companies sell more, and therefore they pay more tax, they have more profits, and they pay more taxes. And then when there is a downturn, the sales go down, and then the profit go down, and the taxes related to that go down. So that is, I would say, very predictable and normal. But apart from that, I don't see a clear trend. So I see, for me, this is a little bit of a puzzle, and I'm looking forward to questions or discussion around that, because I would have expected that as the statutory rate goes down, so as the rate imposed by each country goes down, then also the implicit rate would also go down. But we don't see that, so I'm leaving it there open for comments what the explanation could be.
Thank you so much, Ilaria, for giving us some hard data. I would like to hand over to Dominique. Is what you've seen from Ilaria's analysis surprising you, or do you think this is quite clear what's behind this?
Well, I wouldn't go as far as saying it's quite clear, but I would say perhaps you would be surprised to hear that I'm not surprised by those results. And I think that there are probably two main factors behind those results. So on the one hand, you look at this and you say, well, if corporate income tax rates are coming down, and they clearly are, the data shows that. It's not just a European phenomenon, by the way. So across the world, we've seen corporate income tax rates coming down. Then, as Ilaria says, you would ordinarily expect that there would be a reduction in the level of tax receipts. But I think the main reason why there hasn't been such a reduction is because you see an opposite trend in the other direction, which is around the broadening of the tax base. So in simple terms, the rate may be coming down, but the amount of profits that are subject to that tax are increasing. And that reflects a number of factors. A lot of that is based around tax policy changes in terms of what is in scope for tax. So fewer tax deductions or fewer incremental tax deductions being available, more non-deductible items. And indeed some of the taxation of cross-border flows. So there's an element to which countries are simply increasing the base on which they apply those taxes. Now, I think if you were, how should I say this? If you were a right-wing economist, then perhaps you would look at this and you would say, aha, this is a factor of the Laffer curve. So you reduce the tax rates and the tax revenues go up, or they stay the same. I'm not a great believer in that, at least not in this context, because I think if you look at this data, as Ilaria has shown, this is a phenomenon across Europe. So it's not as if there are some countries who have reduced their rates and consequently they've seen revenues come up at the expense of other countries who have retained high rates. I don't think this is really a case of tax competition, because the data shows that this is the case across Europe. And I think if you were to replicate this data outside of Europe, I think you would probably see a very similar story. I think the other factor which is quite possibly influencing these results is a change in company behaviours. So, and I think I can speak very much more sort of personally and anecdotally here, but 25 years ago, certainly sort of even 15 years ago, I think that the way that people did tax looked very different. I think it was still very common back then to do what I would call black box tax planning. So people would buy some tax planning off the shelf from a clever advisory firm that would reduce the amount of corporate tax that they would pay. And I think that trend really has gone away. So I think there are very few, if any, companies that still use that kind of tax planning. I think that's for two reasons. One, because it just doesn't work. So the changes in tax regimes mean it's no longer possible to do that kind of aggressive tax planning. And if you look at some of the more recent changes, the OECD's base erosion and profit shifting initiatives, the so-called BEPS initiatives, that has closed off a lot of the, not even the most aggressive tax planning, but some of the sort of things which were regarded as perfectly reasonable and permissible and acceptable a few years ago are now no longer available to reduce the amount of tax that companies pay. You look at US tax reform, where there's been a dramatic reduction in the headline corporate income tax rate, but a big broadening of the base, and also a reduction in the number of opportunities for people to do that kind of clever tax planning. So I think there has been a behavioural change there. I think that certainly in Europe, part of that behavioural change is also not just reflective of changes in the law, but also changes in how companies are perceived. So in Europe, certainly, tax has become a CSR issue. Tax has become on the radar for various interested parties. Companies are increasingly questioned about their tax practices. There have been a number of celebrated cases, I won't name them, but where companies have been named and shamed about, rightly or wrongly, in fact, about their tax practices. And I think that certainly has driven behaviour. But more broadly, there is a greater focus on tax as a corporate issue. And as a result, I think those behaviours have changed gradually over time, and that has resulted in less tax leakage, shall we say. So that's another factor which has kept the overall tax take at a broadly similar level, even as the tax rates have come down. So in summary, I think there are a number of factors there which have been moving in the other direction to the corporate tax rates, and therefore I'm not really surprised that the overall tax take, based on Ilaria's statistics, is really holding up pretty well, even as the tax rates come down.
Yeah, thank you. That's very, very interesting that you give a good rationale behind that. I have an even simpler question. What's the rationale behind statutory tax rates coming down?
Yeah, well, I think you'd have to ask the governments around that, but I think more seriously, I think that there are probably two factors. Again, this is just my perspective, my personal view. I think that there has been some element of what you might call tax competition. So acceptance that when some countries start to reduce their tax rates, others must follow because they otherwise become or are perceived to be uncompetitive. I think we shouldn't overplay that factor. I mean, you look at a country like the US, which had an effective corporate tax rate, once you take into account state taxes and local taxes, of around about 40% up until just over a year ago. And so throughout most of that period, when other jurisdictions were reducing their rates, the US kept a very high rate. So there's competition is only a certain element. I think there is a broader question around how economically effective corporate tax rates are, or corporate income tax is, to start with. So I think that from a policy perspective, you will talk to a lot of economists, and it'll be interesting to get Ilaria's view on that, who say really corporate income tax rates are not, it's a bit of a myth to regard corporate income tax as a tax that is borne by companies. It's a tax that is paid by companies, but ultimately it is borne by the beneficiaries of the residual profits that companies make, whether that is their shareholders, whether that is the employees, whether that is people within their supply chain. Ultimately, it's not something, there's not a sort of, a company is almost a sort of fictitious entity. And so there is some view that actually collecting corporate income taxes is not a particularly efficient way of operating. And I think to get the wider perspective on how tax rates have evolved over that period of time, you also need to look at what's happening to other taxes. So I think there has been, over time, certainly over the period that Ilaria is looking at, an increase in various forms of indirect taxes. So classically within Europe, VAT rates have, on balance, have tended to move upwards over that period of time. And VAT is a very easy tax to collect, so it's economically quite efficient. Whether you think it's a good tax or not, it's very easy to collect for governments. And I think there's also been a big trend towards more other taxes, shall we say, some of which are borne by companies, some of which are borne by other people within the overall economy. But I think if I just look at the UK, where I'm based now, you can see that there are, every year there seem to be some new special taxes, whether that is sugar taxes on soft drinks, or whether that's an apprenticeship levy in the UK, which effectively has turned out to be pretty much a new tax. Those new taxes are bringing in more revenues, and so proportionately the amount of tax that needs to be collected from corporates is not so great. So I think there are a number of different factors involved, but it's not all about tax competition between countries.
I understand. Very interesting view on who's actually bearing the corporate tax. That maybe we pick that up later in the discussion again. Before we do so, I would like to ask Ilaria, try to summarize for us what are the different positions of different stakeholders in this debate, because obviously there are different interests here at work, and it might be good to understand the different views. Ilaria?
Right. Okay, so I guess some of the things that Dominic mentioned will come back in this part of the conversation, and I will try to address a couple of those because he raised very interesting points. But so starting with competition, because I believe that part of the reason why statutory tax rates have been declining across the world, but in Europe in particular, has to do with two elements. One is globalization, and then the other one is the nature of the European Union as well. So starting with globalization, what happened? Well, we have markets that are more integrated, and companies operating across different countries. I mean, the large companies, of course, not every company operates across borders, but in this new framework of global competition, you can see companies having an interest in optimizing, because they face competition from other companies that are in the same situation. So there is an interest in doing more tax planning in order to be more competitive. So that's on one side. On the other side, there is the state pushed in a way in a corner, because it has to look at two issues. On the one hand, as a state, you want to attract economic activity coming to you, and therefore you have an interest in lowering the corporate tax rate so that companies are more interested in doing in setting up activities in your country. Now, of course, whenever a company decides to operate in one country, there are 1,000 factors that come in this decision, from cost of labor, availability of skilled labor, the quality of infrastructure, physical and immaterial infrastructure. But I think the tax issue is part of that equation. So as a state, you want to be competitive from that point of view. But at the same time, we saw now, I mean, after 30 years, we understood that the globalization entailed a lot of changes in the labor market, especially, together with technological change, of course, such that the demand for welfare services increased. People lost their job, or they required training in order to remain employable. And so the state also needs to finance those services. So it's a tricky decision, and I think part of what Dominic said about how taxes shifted from mobile to less mobile sources of revenues has to do with that. So as I said, you have on the one hand more competition between companies, more competition between states for attracting companies, and then on the other side, a higher demand for services that has to be financed somehow. So this is what globalization, this is how globalization enters this debate, in my view.
Okay, thank you, Ilaria. What is your view on this interpretation of the trend, Dominic?
I think that must be there must indeed be an element of that in terms of globalization. I mean, I wouldn't have much to add, but I would say I wouldn't overemphasize the amount to which tax plays a part in investment decisions. And the reason I say that is just simply from my own personal experience. I think as a tax professional, quite often you are struggling to be heard within a business because tax is not the biggest factor that people have when they're considering where to make an investment. So principally, people are looking at factors like the availability of labour and other resources within the supply chain, the skilled labour that they require, or they're looking at economic stability within a jurisdiction. Tax is on the list, but it is quite a way down the list. And I think you also look at how companies have tend to be internally incentivized, and how analysts and markets tend to look at companies. And rarely is tax a big part of that. I think that I'm talking here about public companies. I think there is probably a different set of factors at play when you look at private companies, which don't have public shareholders there. I think sort of there is probably a greater focus on what the net of tax answer is, and so tax probably rises up the list of priorities. But as I say, I think that for public companies, tax is a factor, but it's not top of the list. It would not be generally in your top 3 reasons why you'd be investing in a particular jurisdiction. So I would not overemphasize that point.
Do you think, Dominic, that this emphasis has shifted somewhat? I think you mentioned that already over the last, let's say, 20 years, because when I was still a corporate, I would have said sometimes for certain decisions it was a bit higher than what you're saying now.
Yeah, I think there's certainly sort of an element to which it has shifted, and I think that tax is a double-edged sword now. So I think that sort of people look at, sure, they're looking at their tax as a cost, but they're also looking at tax as a risk. Whether that is a risk of being involved in painful compliance and dispute resolution issues, but probably more likely as a risk in terms of reputational factors. And here I would say that has been quite a big trend and a big change really over the course of the last 10, 15 years, and it's a continuing evolution. So I think certainly if you look within Europe, the focus that there is on tax as a reputational challenge is just dramatically greater than it ever has been in the past. I don't think that's not uniform. So in North America, for example, there's a very different perspective, and I think that you will not see quite the same level of interest in tax as a sort of as a reputational challenge, and there's not quite the same level of, or certainly doesn't seem to be perceived to be as much reputational downside from the way that you conduct your tax affairs in the US vis-a-vis Europe. The picture is more mixed outside of those two continents, but it broadly that's the sort of the difference in the spectrum between the US at the sort of at the one end and Europe at the other. I think there's also, as I alluded to earlier, there's a difference between public and private companies, and there's also probably a difference between different kinds of companies. So in very obvious terms, if you're a consumer goods business, then you are very interested in what your consumers think about you, and getting a bad reputation, even for what used to be quite an esoteric area like tax, is something that can damage your brand and can therefore damage your business. Similarly, if you're a business that has contracts with governments or sort of quasi-governmental organizations, then tax is likely to be a bigger reputational issue to you than if you are a purely B2B business. So I think there are different perspectives there, but I think certainly sort of in answer to your question, the trend has been that tax as a risk area, as a reputational area, has become much greater than it ever was in the past. And I think that probably is another factor which plays on behaviours, and therefore the phenomenon in terms of tax collections, which Ilaria has noted.
Yeah, no, I get that, and I think that trend is also reflected in the numbers. Ilaria, then I understand you looked at more aspects where the views differ.
Yes, so basically I looked at 3 issues which I thought made this debate, exacerbated a bit this debate. I mean, I don't think that everyone comes out together at dinner with friends and say, hey, let's talk about taxation issues. But I think it is true that since the Panama Papers and the LuxLeaks scandals, this became a bit more of a controversial topic and more discussed in the public debate than before. So what I tried to do was to really look at the issues that make this conversation and this problem more difficult. So I tried to disentangle them. So as I said, one was globalization. The other one, which I'm going to mention now, is the competition between EU countries, so the nature of the EU itself. And the third one was the digital companies, which are in a way a separate chapter that we will see. So coming to the second issue, which is tax competition between EU countries, I want to start with a quote by a professor that teaches in Geneva, Professor Baldwin. He's an expert of trade, and I heard him once saying that the EU is globalization on steroids, because the depth of the integration and the ability of people and goods and capital and services to move is unprecedented. So I think it's a nice way to explain what the single market is. And what I want to say here is that what we just said about globalization and how it increases competition between countries to attract economic activity is valid also for the EU, but it applies in a even a stronger way because of the nature of the EU itself and the ease to move things across borders. And so this means that, I don't know, imagine Belgium and the Netherlands. It's two countries where things are very similar, like availability of skilled labor, the language. Well, in Belgium there are two languages, but one of them is the same as Dutch. There is the size of the country is the same, the infrastructure, the physical infrastructure are the same. Actually, most of them are shared. So imagine you have two countries which are really very similar on all other issues. Then the tax factor, given the ease to move things across border, becomes more relevant in the decision of economic activity, in the decision of companies on where to locate their offices or their factories. And so this creates further competition between countries to be able to attract this activity. So that's why there are some studies that show that there is a race to the bottom in corporate taxation in Europe because of the strength of these factors. So that's a bit the view from the EU, and I think that's interesting that in light of that, there's been some attempts by the European Commission. I think the first one was probably in 2005, and then it was shelved, and then again more recently to try to deal with this, to try to deal with the fact that there is a huge market where a lot of things can move, but still taxation, every form of taxation actually is very different. And so that from there comes the idea of creating a common base for companies that operate across borders, so companies of a certain size, to calculate their taxes. So I find this an interesting proposal. It doesn't seem it's really taking off in the debate. It's also probably because the Commission is, I mean, we have elections in 10 days all over Europe, and this Commission is about to finish its mandate. It doesn't seem to take off, but I would be interested in hearing what Dominic thinks about this CCTB proposal.
Before you reply, Dominic, let me just point out to the audience, we're still very keen to hear also your views and your questions. I remind you of the box on the left bottom corner of your screen. Just send us small messages and we will include them in our discussion. Dominic, what do you think of that proposal Ilaria just mentioned?
Well, before I come to that, I just say one other point, which I'll just reiterate that it's not just about corporate taxes. So I think Ilaria is absolutely right that clearly within the EU, it is much easier to make investment decisions cross borders. Often you're making a decision which is just a matter of a few kilometers in one direction or another. So in principle, it's very straightforward. But I think that corporate income tax rates are a factor, but not necessarily the highest factor. So to give you an example, I think that it is much more likely that you will be influenced by the availability of labour directly in the jurisdiction where you're looking to invest, or even some of the non-tax incentives that might be available. So if you compare, for example, different incentives around research and development, R&D, it's very clear that you have not a very generous tax regime in Germany around R&D if you compare to a number of other countries. However, there are very generous opportunities available above the line, so outside of the area of taxation. So it's sometimes a bit misleading just to look at tax as being the factor that might influence that kind of decision. That said, I think sort of in terms of the EC proposals around a common consolidated corporate tax base, or at least a common corporate tax base, let's leave the consolidated piece to one side, I think that you might be surprised to learn that as a tax professional, I would absolutely welcome that. I think that maybe 20 years ago, tax professionals might have been looking at those differences in the tax regimes across Europe and thinking that those were an opportunity. It might be an opportunity where you might have different tax treatments in different countries, and you might have a cross-border flow where you get a deduction in one country and you get no taxable pickup in another country. And you might think, great, this is a tax planning opportunity. I think those days are very firmly in the past now. For all the reasons I mentioned earlier, so whether that is through legislative change or whether that's broader behavioural change triggered by the way that people do tax these days. If anything, it's a headache that we have a variety of different tax regimes, and the compliance burden associated with having to understand the tax regime in each of 28 different countries across Europe, and then having to file your tax returns accordingly, much outweighs any opportunity that there might be. And indeed, there is also risk that you have double taxation, where, for example, you don't get a tax deduction in one country, but you do get a taxable pickup in another. So consequently, I think that from a corporate perspective, and certainly speaking sort of personally, I would very much welcome a common corporate tax base across Europe. I think the reason why we don't have, and I suspect we're not going to have a common corporate tax base for some time to come, is much more because it will be very difficult to get 28 member states to agree to what that tax base would look like. And that is because those member states, those governments, are each looking at how they want to incentivize particular forms of industries within their country. So they want to have the flexibility to adjust the tax rules to suit their economies. Why wouldn't they? And you can understand that, but they don't therefore want to surrender that right, that ability to adjust their tax base. And as we noted earlier from the statistics, actually the size of the tax base in some ways is much more important than the size of the tax rate. So consequently, I think it's a noble and laudable aim from the European Commission, but not one which I would expect will be a reality anytime soon, at least certainly not across the whole of Europe. As to whether it might be possible for a subset of countries on a more voluntary basis, that perhaps is more feasible.
Yeah, that is very interesting. Indeed, you surprised me by saying you would welcome it, but when I listened to your arguments, it became quite obvious. But also, I tend to agree with you. There are incentives by the national governments not to move at a high pace. I was just intrigued by a comment you made about above the line differences. Could you just elaborate a little bit more about that? Because that makes the tax debate even more complex, doesn't it?
Yeah, absolutely. So I think sort of typically, and this is one of the things that makes a tax professional's job quite difficult, people across the business are not really focused on what the net of tax result is. They're focused on the profit before tax, or even the operating profit. So they're not necessarily even that focused on what the interest charge might be, for example. And so consequently, I think governments are starting to get wise to that. Let me give you another example from the UK. The UK used to incentivize R&D through an R&D tax credit. And so effectively, the government would subsidize, would give you a higher tax credit than the 100% of the expense that you had suffered. And that was great in some respects. It could reduce your tax charge. But I think what they discovered was it wasn't really influencing behavior, just because people are not that focused on the tax line. What they did as a consequence was they altered the nature of that tax credit, and they now have a tax credit which, for large companies, can be taken as an above-the-line tax credit. And what that means is that when decision makers are looking at where they want to incur their R&D spend, they're thinking about what their overall budget is, and if this tax credit can be an above-the-line tax credit, it's something which can be a credit to their budget. In effect, it makes their budget that much bigger, and they can spend more money if they are, or their money can go further if they spend it in the UK compared to a country where they only get a tax credit. So I think sort of in behavioural terms, giving a credit above the line is typically far more effective. Now, obviously, within the EU, there are also certain limitations as to what kind of state aid is made available to companies, and there are very sort of strict limits within which that can operate. But if you look across the world, it's a phenomenon that there are. I mean, look at the US, for example. There's competition between different states within the US to attract investment, and that often is, sometimes it's in the world of tax, but as often as not, it's in above-the-line credit.
I think it's interesting, Dominic, that you mentioned the US, because what is remarkable is that in a way you have between US states not as much difference as the differences between EU member countries, but still quite a difference in levels of income, labor cost, and all sort of economic indicators. But at the end of the day, in the US, there is a common federal corporate tax rate at 21%, and then US states can top up, can add to that. But there is one common rate that goes into the federal budget, and so this is, it's a strong justification for having something that is at least similar in the European Union, given that we have similar levels of integration.
You say that, Ilaria, but of course, if you look at the state taxation within the US, there isn't a common base. So it's very interesting within the US, and I'm sure that many participants on this call will be much more familiar with this than I am, but within the US, states can elect whether or not they want to apply any changes to the federal tax regime in calculating state taxes. So, for example, in the recent tax reform package, there are a number of big changes to the tax base, things like the reduction in the deductibility of interest, or harsher restrictions around the deductibility of interest, things like the new base erosion and anti-abuse tax, a number of these different changes which have been put into effect on a federal level, but states are still now deciding whether or not they want to conform with those changes. And many of them are deciding, no, we don't want to make that change. And so in effect, they have a different tax base for state tax than is the tax base that's applied for federal taxes. So there's still that difference within the United States
right
itself.
So they have a different tax base, but a common rate, at least a minimum, whereas the current attempt...
They don't have a common rate. It says that on a state level, they have different tax base and completely different state rates. So, there are states which have zero state tax. So therefore the base is rather irrelevant, but there's a wide variety of different rates of state tax, and there's a wide variety of different tax bases. It's the federal rate of 21%, which is applied consistently with a consistent tax base across the United States.
Guys, in all fairness, we have a lot of Americans on the call, I think. They're probably more knowledgeable than we are. Let's stick to our home turf, and I'm conscious of time as well. Ilaria, would you care to open the discussion around your third element, the digital aspect of this?
Right, but the conversation was very interesting, so I'm sorry we have to abandon this one. But I think the issue of digital companies is also very, very interesting. It's an issue of modern times because, in a way, the taxation rules were conceived in pre-digital times, in pre-internet times. And so in a way, the digital companies are challenging the existing rules because a lot, for example, taxation is expected from companies when they have a physical presence in a certain country. But there are businesses, digital businesses, that can do, that can sell, can do economic activity in a country without eventually any presence. And also it's tricky because it's also difficult to identify what makes a sale in some cases, because, for example, I don't know, in the case of Facebook, it's difficult to understand what should be taxed and on what basis. Is it based on the number of users? Is it based on the number of advertisements sold? So this is fascinating because digital companies open a new set of issues, as if what we talked about before was not complicated enough. But basically, yes, the discussion is what should be taxed in this case, and what is creating the value of these companies. Is it the number of users? Is it the number of advertisements sold? Is it intellectual property that often resides in the Silicon Valley? So I think that there is a huge debate. It's really not clear what is the way out on this one, and how and what makes a responsible tax in this case. I think it's even more complicated to define than all of the issues before that we discussed before.
Dominic, as you already pointed out with your blank wall behind you, that you have some experience with digital business. What's your view on this?
Sure. Well, an issue very close to my heart, as you can imagine. I'm going to be a bit controversial. I'm not convinced that there is a problem which is specific to digital companies. I think we need to sort of break it down into two questions. The first question is there wide-scale tax avoidance associated with digital companies? And secondly, is the allocation of taxing rights correct? And I think the first question, which is really sort of the BEPS question, if you like, is there are digital companies able to do aggressive tax avoidance which other companies are not doing? And I think that there isn't really evidence that that is the case. It's possible that may have been the case in the past, but I think that the changes which have already been made as a result of the BEPS project, and also, let's be clear, the US tax reform in particular, because many of these companies are US headquartered, I think that the evidence is not there that these companies are actually paying less tax. In fact, interestingly, there have been a number of economic studies which show that digital companies on average pay slightly more tax than non-digital companies. I want to keep emphasizing that one because the European Commission keeps quoting a survey which they think proves the opposite, and the authors of that survey have said that they've just misinterpreted the survey. But be that as it may, I don't think that sort of the issue with digital companies is around not paying enough tax. I think there's an increasing recognition that the challenge with highly digitalized businesses is around the allocation of taxing rights. So not how much tax they pay in total, but where they pay tax. And if you bear in mind that, again, most of these companies are either US headquartered or have a very large part of their value creating activities taking place in the US, really it's a challenge to say, should some of the profits that are currently being taxed at the US, by the way, at pretty high rates, be taxed elsewhere, typically in the market jurisdictions where these companies are making sales. And even then, I think that is a highly contentious, debatable question. And you look back to where is value really being created in a digital business model. And I still think that most of the value is being created by smart people who are designing algorithms or coming up with clever ideas, and that's where the value in a lot of these digital companies that you mentioned, that's where that is coming from. There is clearly sort of value in being able to sell in a market, but that is not typically how we do corporate taxes. We capture that value, we capture the value of the market in indirect taxes, not in corporate taxes. So I think the jury's out on whether there really is a problem, but it doesn't matter what I think. The OECD is currently looking at it, and I think what the OECD have wisely realised is that if you're going to make a change to the way that we do international taxation, and particularly the way that we allocate taxing rights between different countries, then it can't be just about digital companies. It's very hard to define a digital company. I look at my own company, which over time has evolved and become a much more digital company than it was, say, 10 years ago, let alone 20 years ago. But I think all companies, in one form or another, are moving to become more digitalized. And so trying to draw a hard barrier around a group of companies and say, these are digital companies and other companies are not digital companies, I think is destined to failure. And in time will just be a sort of an anachronism. So I think that if we're going to look at the way that we do tax globally more fundamentally, then we need to look at that across the board, and all companies will be affected. And I think that's what the current initiative, which, by the way, is due to report by the end of next year, the current initiative at the OECD is recognizing that and saying, well, whatever we come up with, the likelihood is this is something which will apply to all companies. And so I think there is a high likelihood that we will see some change there, and that's going to affect all of the companies who are joining this call.
Yeah, I think I would share that view in the sense that the borderline between physical brick and mortar company and digital is moving very rapidly. And if you take companies who live in the physical world, but their algorithms just provide allocation of services, then where's the borderline?
Can I play the advocate?
Of course.
The devil's advocate. No, I think there is an issue that comes into the discussion, and it refers also a little bit to what Dominic was saying at the beginning, a bit like philosophical, who pays the taxes at the end? And ultimately, every taxation goes into the price paid by consumers. So at the end of the day, it does go there. But there is a reason why states apply a taxation, different forms of taxation, of course, to companies and people, to income and wealth, and that's because services are provided with those money. And so this is interesting in the case of digital companies, because digital companies use somehow the infrastructure of the state, and the question is whether, like, okay, let's take an example. So a digital company that pays taxation only in the US, but the same digital company has customers and consumers all over the world, and these consumers are using the internet infrastructure, the cables that are installed by public companies or by the government. So in a way, the companies is taking advantage of that, but not contributing to that. So I think that's what makes it difficult for states to take also to claim that the taxes cannot be paid only where the headquarters is, even though the intellectual property and the value is invented there.
I think it cuts both ways, because firstly, I think a lot of that infrastructure is provided by private companies who are being remunerated for their use by those digital companies. So, and indeed, there are a lot of other aspects of the supply chain which are being appropriately rewarded. So you think about the uptick in sort of online orders of goods, and that's resulted in many more jobs in deliveries of said goods. So I think that there's an element around that. I think there's also an element around competitiveness of domestic businesses. If you were to suddenly make it more expensive to buy your components via Amazon, or to indeed to have your hosting through their web services, then actually it makes your own domestic companies less competitive. So I think I'm personally not a believer that that is as fundamentally different as people would make out. It's certainly more difficult for tax authorities who are have a mindset and have a legislative regime which is configured around having a physical presence. But frankly, if you create new criteria for a physical presence, but there's still no actual value being created in that market, there's not a lot of point. So really, it comes to a much more fundamental question, which is, where is value created in digital models? And frankly, most of that value at the moment is being made by smart people in Silicon Valley. And you could argue that the smart move for governments would be to incentivize more of those jobs to be created in their own markets, and therefore the value will follow. And indeed to build the right kind of education regimes that attract the best talent to their jurisdictions. And if you do that, you get the money.
I think both of you made interesting points. It would merit a much longer debate. We've, I think, very clearly indicated the complexity of the issues. It's not something that one can discuss emotionally, and the facts have to be brought together. Unfortunately, with this good debate, we didn't manage to address questions from the audience, but no doubt if the audience has questions, you can still contact Dominic, myself, or Ilaria. I would summarize the point is it is important for people outside the tax departments and corporations to get a better understanding what the issues are, how they're being addressed, and therefore work on the transparency of what you do, because that helps to have a fact-based discussion. Thank you, Dominic. Thank you, Ilaria, and thank you to the audience. And please don't forget to give us a brief evaluation of this webcast. And my last point is that in this series, the next webcast in 4 weeks' time will be about responsible digital. So we're going to get more into the debate that we just heard about. So thank you for it, and goodbye.